It's another hour of markets analysis and insights on Business Incorporated live from Channels TV Lagos, and here's what's coming up. Kenya's fuel consumption drops to lowest level in 5 years amid high pump prices. And Ethiopia is optimistic on debt deal with creditors in early 2024. Nigeria's inflation jumps more than expected to hit a new 18-year high. Hello and welcome to the program. I'm Will Ibang. Let's kick off as always with market numbers. First up, major equities in Africa. We've seen intraday, the major equities, which is South Africa and Nigeria, trading in positive territory. Nigeria is up 0.14%, while South Africa is 3.65% up. Very strong at intraday, and Nigeria maintaining that 72,000 level. Let's see how Egypt, though it was closed on Thursday, traded down 0.21%, and we've seen Kenya in the red for yesterday's trading session. Now let's look at the Middle East, where major equities are also closed today, except in the UAE, where we see Abu Dhabi trading in positive territory. It was up 0.23%, and Dubai also up 0.48%. Elsewhere, let's see how Saudi and Qatar performed. They closed yesterday, but they closed also in positive territory. Very good one for that region. And now we go to the EU, where Germany's relations with China have been difficult in recent years, not unlike some other country ties to other country ties to the world's largest, second largest economy. And Lars Alter joins me from Berlin. Lars, a new study has looked into how important China really is for the German economy and whether Germany can do without trade with China. First of all, why does a study like this exist? Is this such a decoupling actually planned?
Thanks for having me, Will. No, such a full decoupling is not anyone's goal, definitely not at this point. But we've heard of the word decoupling a lot earlier this year, before economists and politicians eventually settled on de-risking from China as their new strategy. It was and is in an effort to become less dependent on China, because that country has not necessarily been a reliable partner in recent years, and it also doesn't share the West's values, let's say, in terms of human rights or protecting the environment. So there's a lot to consider when trading with China, and I guess it can't hurt to at least get an understanding of what options one would technically have if a more radical split had to occur at some point. Let's say if there was an attack on Taiwan, for example, just to mention one scenario that would likely make the West reconsider its ties to China. Little sidebar here, remember how Germany encountered huge problems when it had to drop Russia as a source for its natural gas. People had long underestimated the utter dependency we had on Russia. Now we're trying not to make that mistake again. So this study we're talking about is called What If? And it analyzes a Cold War 2.0 scenario. It looks at a world economy split in two distinct blocks, the G7 and Western economies on one side, and China, Russia, and a few allies on the other side. And then there's a few neutral countries, and those would be the only ones trading with everyone, while there would be a complete cessation of trade between the East and the West.
So if there was a complete decoupling of the economies, what would it mean for Germany and also for China?
Yeah, we need to talk numbers here. In case of an abrupt cold turkey-like scenario, a radical decoupling, Germany would see its gross domestic product drop by around 5%. That's according to the analysts. That would put such a scenario on par with the global financial crisis or the coronavirus pandemic. It would be brutal, but we could deal with it. About a quarter of the financial effects, however, would be permanent. I want to quote the report here. The experts are saying, while severe, these costs are not devastating but could be managed with appropriate policy. Generally, German welfare would of course take a hit, and this might need some background. Germany's trade with China is worth around 100 billion euros per year. Germany imports a lot from China: resources, agricultural products, and obviously consumer goods, benefiting from lower prices, which then again, of course, means affordability to the German customer. Germany also exports a lot to China, including machines, cars, chemicals, materials, and those exports obviously support a lot of jobs in Germany, and that's pretty much where the main fallout would be in case of a decoupling. As for China, it would pay a much higher price, according to the analysts. China would see its GDP drop 8 to 20% in the short term and see a long-term loss of up to 5%.
So let's turn to the markets. What are investors looking at today, last trading day?
Yeah, it's quite a festive mood on trading floors everywhere. It all started on Wednesday already, with the Fed in Washington announcing 3 interest rate cuts in 2024 and markets rallying immediately. Other markets followed, especially in Europe, and that as the European Central Bank and the Bank of England yesterday both left rates untouched and promised to keep monetary conditions restrictive for as long as necessary. Now, that doesn't sound quite like it would fuel a rally, but it did, because inflation.
Thanks, Laz, for that. I think we lost Laz there, but thank you for that update from Berlin. We move to the U.S., where stock futures climbed early on Friday as the Dow Jones Industrial Average looked to add to this week's gains, which have led to the 30-stock average to an all-time high. We see Dow futures rose by 0.26%. S&P 500 futures inched up also by a similar margin, and we see the Nasdaq 100 futures rising 0.33%. Now, the major averages are headed for their 7th straight positive week. Now, let's hear more on how the indexes performed yesterday from Maria Bird.
The U.S. stock market was up on Thursday, and stocks that were sensitive to the interest rate hikes are also showing rallying on the day on Thursday, as the Federal Reserve announced we could see cuts in 2024. The Dow Jones was up at 0.4%, its second straight day of breaking records. And the S&P 500 was up at 0.2%. And the heavy tech Nasdaq was also up at 0.2%. Many investors are hopeful and watching to see what will happen till the end of the year. And the last meeting of the Federal Reserve on Wednesday made great announcements for many investors. As it appears that there will be no more hikes before the end of the year, and there could be up to 3 interest rate cuts in 2024. This pivot has many investors hopeful, and this could mean the U.S. economy is up, going in an upward swing. It is also showing that the real estate market showed a 3% increase, which could mean the real estate market is going to be strong in 2024.
Thanks, Maria. Now, as we embark on the journey into 2024, the African financial landscape stands at a pivotal juncture, shaped by the lessons learned in the preceding year and poised for new opportunities and challenges in the coming years to come. Now, in navigating the intricate dynamics of the African financial markets, we also saw the Africa's cross-border security trading and the African Exchange Linkage Project. Benjamin Boshi is the chief economist at Second Stacks. He joins us from Accra, Ghana. Good afternoon, Benjamin. It's good to have you on the program.
Thanks for having me.
We're looking at an overall assessing what happened in 2023 this year as we're about to end. What are the key trends or developments that you feel shaped the financial landscape in Africa, and what's currently shaping it at the moment?
Sure. I'll start in Ghana, because I think Ghana pretty much set the trend for a lot of the continent. Because as you probably know, and I'm sure many of your viewers know, Ghana went through a very elaborate debt restructuring program, which saw its domestic debt get exchanged, and is currently working on getting its external debt restructured. And Ghana also locked in an IMF deal, which will support the budget for the Ghanaian economy over the next 3 years. That support is coming in tranches. But it also requires Ghana to adhere to certain pretty strict governance targets. So looking back on the year, it was definitely a tumultuous year, but looking forward, there's some structural support built into what the Ghanaians will see next year. Moving to Kenya, it was a little bit of a difficult year there as well. The currency depreciation was pretty intense, to the point which Parliament was issuing threats to the central bank governor and the other members of the economic management team, basically saying if they don't get the house in order in short order in early 2024, there'll be consequences. So we're going to be looking for pretty structural reforms, focusing on the currency in particular in Kenya. And then in Africa's largest economy, Nigeria, was also a very difficult year. The Nigerian naira saw a pretty steep devaluation. But Nigeria is in a new government. There was an election recently. President Tinubu has come in. He's managed to put his team in place. So we're probably going to be looking for some broad structural reforms there. This is a government that has its mandate, and it obviously has a task ahead of it. So you can look for some pretty big swings. And Nigeria. Yeah, so go ahead.
Okay, so you're looking at you just mentioned all the regulatory, the economic policy shifts that we saw this year, and that has been shaping, financial transactions, the financial markets. I want to know, your second stacks is big on technology here. How has this technology influenced the financial markets, and what role does innovation play in shaping investment strategies?
Yeah, definitely. So, for context, as I'm sure you know, the African Continental Free Trade Agreement is starting to really ramp up in 2024 and beyond. So cross-border trading of securities, movement of capital, goods, services, and humans, these are all things that we expect to intensify in 2024 and beyond. And the way to be successful with this continental integration is certainly the leveraging of technology. So, as you mentioned, cross-border securities trading, we think is going to see unprecedented levels in 2024. And Kenya has gone visa-free in 2024, and a couple other countries are also taking steps to ensure free movement of persons across the continent. So, I think 2024 is going to be a banner year for continental integration. And as you mentioned, yes, technology is going to be key to succeeding on that front.
So we're looking at another aspect now, which is what we're saying, climate change. And you see the recent consensus reached at COP. With growing emphasis on sustainability, how are environmental, social, and governance as the ESG factors influencing investment decisions in the African markets? Can you just shed more light as to what to expect for 2024? If we have any milestones that have been hit this year, or are there any things, or are there factors that should be considered going forward?
Yeah, absolutely. I think there's a major push towards restructuring the entire architecture of ESG, of concessionary financing for the continent, for impact. And 2023, it was a difficult year globally. So I don't think we were able to see all of the metrics hit that we would have liked. So I would expect to see a redoubling of the efforts in 2024. Not to shift too far into the COP discussion, but you did see some progress there. I think you'll have a guest who will make some more comments on that. But more importantly, for 2024, I would expect a lot of multilateral continental activity, right, to push the impact front, the ESG metrics, and making sure that our partners are living up to the promises that they make. Because in the broader context of continental integration, ensuring that the most vulnerable on the continent are taken care of is always going to be paramount and foremost.
Thank you so much, Benjamin Bochi, Chief Economist at Second Stacks, for joining us on Business Incorporated and sharing your insights.
Thank you.
Thanks for staying with us. Now, in the aftermath of COP28, the global stage witnessed a critical assembly of minds on climate action, plus the potential consequences of COP28's decisions or lack of thereof on crucial articles related to carbon trading activities. Joining us for an insightful analysis on the outcomes of COP28 and what it means for our planet's future is Decoupling, energy expert and vice chair, African Energy Council. Good afternoon, Chinan. It's good to have you on the program.
Hi, Will. Great pleasure. Really good to see you again.
Now, Chinan, with COP28 done, dusted, well, hopefully, could you summarize the key highlights and outcomes from the conference very briefly?
Yeah, so I think it wrapped up on Wednesday of this week, and key outcomes there have been quite a few, but I'll just say it this way. There was a huge amount of optimism going into COP28. Many of the, sort of climate experts were hoping for, a very meaningful deal, if you like. Now that we're finished, quite frankly, I would say the balance of the outcomes of, if you ask me, I'd say moved more towards oil and gas companies than towards climate justice. And there are several reasons why that's been the case. Yes, for the very first time, we have incorporated in the final text message about transitioning away from fossil fuels, to clean energy. So that's a big win, but it's still vague. It's still a bit unclear. There are no deadlines or deliverables in there. There are no clear commitments in terms of finance and stuff like that. So it's generally a step in the right direction. But quite frankly, I would say, Will, many oil and gas companies will be leaving Dubai much happier than they came.
That's interesting, because this is the first time we've seen this landmark, historic, everybody coming together, reaching a consensus. But why is the inclusion of language on transitioning away from fossil fuels in COP28 significant? And how does it advance the global discourse on phasing out fossil fuels?
Very important question. So the reason for that is energy, as we know it, accounts for approximately 60% of global CO2 emissions. So it's the largest chunk. It's basically the largest chunk of CO2 emissions. And it's the reason why, there's all of this climate talk all around. So if you're going to make 1.5 degrees C, 1.5 degrees centigrade, as per the Paris Agreement, if we will hit that deadline, then we would have to start to tackle energy, i.e. oil and gas, yes, also transportation, but primarily oil and gas. So that's the whole significance there. So putting that text in there to say that we're transitioning away from oil and gas into clean technologies is a very powerful and a very forward-thinking step. I think the big debacle here is that it's so little, so late. It's not very definite. It's not clear. It's not backed by finance. And I think that's the foray. That's what people are pushing about and a little bit disappointed about. Where is the clear mandate to say, one, we're transitioning in this particular way, and this is the deadline, and this is the amount of money that we're going to vote to make sure we move over. That's where the disappointment comes in.
We've seen this lack of clear finance targets. It needs to be clearer. But what are the potential consequences of the failure? I'm just reading out here to make decisions on Articles 6.2 and 6.4, particularly concerning carbon trading activities. If there's an absence of international standards for transparency and integrity in carbon markets, what does this mean for Africa, especially, Chinan?
So it's a very powerful one because, that article you quoted there, 6.2 and 6.4, they have to do with carbon trading. Okay. And currently there's a bit of carbon trading happening. There's a voluntary market, there's a compliance market. Unfortunately, what's happening in those markets is there is no clarity in terms of what really qualifies as a carbon credit. So what's happening today across the world is, for lack of a better word, there's a lot of misrepresentation, there's a lot of fraud around that area. It's a bit of a cop-out for many oil and gas companies. They're able to walk away and use those credits, to their advantage, as opposed to really committing to renewable energy or decarbonization programs. So the lack of taking action on Article 6.2 and Article 6.4 again gives a loophole to many companies, oil and gas companies and several companies, to continue to activate and evade taking concrete actions on climate targets. Outside of that, Will, there's also lots of mentions in the text around transition fuels, which, even though they're great, with all due respect, they are very carbon heavy as well. There's also a lot to mention in there around CCS, carbon capture and storage, which again, the oil and gas companies are pushing very aggressively. Okay. But I think on the balance of it, we have made progress in COP28. I just think that a lot of climate activists who are flying out of Dubai yesterday, today, and maybe tomorrow will be more disappointed that they came in. A lot of the oil and gas executives who flew in will be much, much happier than they came in. Lots of the representatives from the US, China, and other big economies that are polluting very heavily will be much, much happier. I think Africa, quite frankly, if you ask me, when I say Africa, I use that as a blanket term. There'll be a bit of disappointment from many African countries.
It's sad to know that Africa will be disappointed in this outcome. We do hope for better outcomes for Africans, especially that we don't produce as much carbon as other industrialized countries. Thank you so much, Chinan Dikwo, Vice Chair and Energy at African Energy Council, for joining us this afternoon.
Thanks for having me.
Now we go on to other stories where Ethiopia's government aims to conclude a deal with bondholders early next year on the terms of a restructuring of its $1 billion Eurobond. That's according to investors familiar with the matter. This comes as Fitch Ratings downgraded as on Thursday into junk territory, citing an increased likelihood of default. Now, sources say private creditors came close to an agreement, but are unable to conclude before the end of December. However, the big obstacle cited of a technical nature related to payment streams. Kenya has witnessed a significant downturn in fuel consumption, reaching its lowest level in half a decade amid high pump prices. Diesel consumption dropped from 687.66 million liters to 658.09 million liters between July and September. Petrol consumption declining from 499.54 million liters to 497.46 million liters. Heating and taxes collected by the Kenya Revenue Authority. Now, recently, oil prices, I mentioned earlier, soared past the 200 Kenyan shilling mark after President William Ruto assented to laws doubling the value-added tax from 8% to 16%. Now, Nigeria's inflation rates climbed to a new 18-year high in November, marking a record level reached in 2005, which may spur the central bank to raise interest rates and also beating economists' expectations. Economists had predicted a 27.9% increase, but we've seen that jump into 28.2%. Now, according to the National Bureau of Statistics, consumer prices rose 28.2% from year-on-year, compared with 27.3% in October. And food inflation rate rose to 32.8% in November from 31.5% in October. Now that's a wrap on Business Incorporated. To join us next week for a new edition. I'm Will Ibong. Bye for now.